Yeah, I don't like Shopify. Like, that's the thing, that's a hype stack to me. It's like, why are we doing this? Yeah, it's new, it's...
Oh, Paul's picking his nose. Yeah, there we go. Got it.
Love it. Nate's over here raging.
Hey everybody, welcome to the show. It's your boy Seth, Uncle Paul. Uncle Paul, how are you? You're wearing white again.
Yeah,
you look dashing in white.
I gotta remember to stop wearing the white.
Welcome to the live stream. Paul and I, if you're new to the show, thanks for joining us. We're here every Tuesday and Thursday going live, talking about investments, stocks, not so much real estate anymore, Paul, but we'll get to that more in the winter. It's not really like real estate time. It's just stocks are so crazy now. That's why we keep talking about them. If you're new to the show, thanks for joining us. As always, it's me, a normal cat with not a ton of money, talking to a guy who has done really well in this world. Paul has owned thousands of units of real estate, has been a part owner of 20 some odd businesses the last few years. And I bring
your numbers change every
well,
time.
Because your numbers change. I was saying 20 businesses, and you're like, we're kind of down to 12 now. So they do change, Paul.
It was never 20. It got to 15 or 16. And now we're down to 12, but the thousands of units. It was 1,000 units.
1,000, and now it's down to 600.
Now it's down to 600 and change.
I bring Paul your questions. I'm kind of playing your role. So put them in the chat. We have a lot of our patrons. Paul, our wonderful patrons are always following us, and they're asking questions as always. Daniel, I see you there. Carpe Diem, Jared. Our day trading specialist, Trader Mo, is in the chat answering your questions as well. And as always, today we're doing, Paul, what are we doing today? Tech stocks. This is something
Everybody loves tech stocks.
Yeah, everyone loves these. And so let's start, Paul. You have a little graph up there that you're coloring. That's very cute of you.
The S&P just hit 3,700. I think this is the, isn't this the all-time high of the S&P? Or did we hit 3,700 once before? Nope, 52-week range, 3,703, kids. 3,703.
What does that mean, Paul?
That means in the last 52 weeks, in the last 52 weeks, the range has been 2191 to 3703. Now, the reason I know this is the all-time high is this is the all-time. I mean, we've never been higher than this. So I always come here when we're hitting all-time highs to see where we're at. So, it's funny. I want to short more, but I agreed with my brother to stop shorting. But as you can tell, I mean, this is insane, guys. Look at the article, main article here on Market Watch. Where is it? So we go to the main article. The stock market is very vulnerable at these euphoric levels, and a timeout is in order. Not a timeout, like a freaking ejection from the game. I mean, this is terrible. The market's just massively overpriced. If you don't understand why that is, listen to our channel. It's just very, very. I just want everybody to remember, you can find good deals right now out there still. But if you think that over the next 10 or 12 years, a portfolio of expensive stocks will do well, I think you have another thing based on history. Is it possible it's different this time? Maybe. But the last 150 years have shown that it's never, ever different. Even when the planes were invented, cars were invented, internet was invented, personal computers were invented, all these things happened. We went to the moon, all these technological advances that happened in our lives, and it was never, ever different. In fact, it's worse today than it was back then when we had bigger, more life-changing changes in the last 150 years.
They're talking about your watch again, Paul. They're on the chat.
Oh, who's they?
Well, you know who it is. Take a wild guess. It's Vinny Vin.
Hey, Vin, do you know what it is? Did he guess?
No, he was incorrect, but it was a good guess. So,
by the way, the funny part is he guessed Richard Mille. So, Vinny, I will be honest with you on this one. I told Mo it was his responsibility, Trader Mo, to tell me not to buy a Richard Mille.
Is that the end of the story?
That was it. Because, well, he said Richard Mille. I mean, that Richard Mille watch that I want is like an insane amount of money. So I do but it does look a lot like Richard Mille, but 1/10 the price. So that's why, Vinny.
Folks, if you're joining us, we welcome you. Paul, I see some new people on the chat. Husky, I see. Thanks for the great comments. People are thanking us, Paul. Guys, here's what we do. We use this 8-pillar analysis. This is what Paul does. Paul, we came up with these 8 pillars because you do that. You've been doing this for years.
It was you basically saying to me, Paul, what is your steps? I'm like, well, here are my steps.
So,
and I'll finally give Seth credit. It was his pillars.
And we're going to use these pillars to analyze some stocks today. These are all off our Patreon request line from a lot of our great Patreon members. You can follow us. The link below will show you the Patreon if you want more access to us. Kevin, I see you there. It's patreon.com/everythingmoney. Paul, let's get cooking using the 8 pillars, and we're going to get into some stocks. Stock number 1.
So remember, we're taking stock requests from people who are on our Patreon. Patreon group is growing a lot. By the way, somebody's asked me this before. Somebody said to me the other day, can I just join the Patreon after the app comes out? No. You can, but the Patreon's going to jump up in price. The reason I'm giving the Patreon at a good price now is I want those to be rewarded who supported us early. The $8 per month will not exist. The $25 a month will go higher. The $100 a month will go higher. The $8 a month will go higher as well. If the app is going to be $15 to $25 a month, I'm not going to let you after the fact sign up. I want to reward those who signed up today. So guys, if you want to join the Patreon in any way, shape, or form, go right now and sign up for the $8 version. You can always upgrade later, and we will honor you on the app and the free app. If you're a Patreon user, you get the app for free. I'm pushing this because I've seen how valuable our Discord channel is. And the Paul Shorts channel is so unbelievably active. Don sends me the stats every day. It is 3 times more active than any other channel we have, and yet we only have 5 or 6 people in there that are users. It's incredible. So do yourself that favor. Go sign up. It's awesome, and you'll get the app for free.
Cillian, I see your comment there. Yeah, if you ask us to review companies on Patreon, we'll definitely get them more than maybe trying to fly through some of these companies. Paul, you were frothing at the mouth to short the S&P. You were literally cursing just before this about shorting the S&P. What are your thoughts on that? Someone's asking.
You know, I want to short more S&P, but I agreed with my brother who is scared of everything in the world that we wouldn't. And he's right. The other thing is, if I short more right now, it's not really going to make enough money to really go, yes, like we're gonna make good money, but it's not going to be. I have enough right now in a short where my position's fine. I'm down about 2% of our net worth on the short right now, and that's with the market going up from. I started at 2,600 after the fall and started shorting up to here. So I'm very comfortable with the position. We're going to make plenty of money when stocks go to where we think they're going to go. It's going to take patience. And all the while, I'm also selling puts, selling calls, and investing in some stocks. And by the way, join the Patreon, and you'll get my weekly. On Friday, we release my weekly. Here is my current portfolio. Enjoy, have fun.
David Spicer is saying the S&P 500 to 5,000 next year. Respond. My son George Kirchanan, my 10-year-old son, he's learning a lot from you about stocks. We'll just be at dinner eating like macaroni and cheese and hamburgers, and he'll say, "Dad, did you see the PE of Intel today? It's incredible." Paul, let's get cooking here. F5 Networks. This is brought to you by Lemons, one of our patron members. F5 Networks stock. Go ahead,
they're
Paul.
a market leader in application delivery controller market. What the F is that? So the company sells products for networking, traffic, security, and policy management. Its products ensure applications are safely blah, blah, blah. Okay, so they've been around, Max chart. They've been public since 1999. Guys, look at this chart. They hit $73 a share and didn't get, in 1999, and didn't get back up there until May of 2010. 11 years it took for them to go from their previous high to match that again. That's what I'm saying when I talk about companies can still stick around, still grow like crazy, and still fall big time in price. Just don't forget that. And they went all the way down to $3 a share, kids. From $72 to $3 per share, and now they're back up to $169. So are you going to be the genius that bought them at $6 a share saying, oh, if it was a buy at 72, it's a buy, it's a huge buy at 3? No, you wouldn't have been that genius. Trust me. So
What is the market cap of this company, Paul?
call it let's go call it $10 billion just to round it up. We're just going to round to billions. $10 billion.
And the first pillar is PE ratio, price
33.
to earnings. A little high, Paul. We want that less than 20.
So we're at 33 right here, guys. We want this less than 20, so it's an X there. Profit margins next to pillar. 12.6%. Check mark there. Even better, their gross margin, 82%. Gross margin is for every dollar they sell in extra services and sales, they make 82 cents added to their profit. That's incredible because these are their non-fixed costs. These exclude all their fixed costs and costs to operate the business. This is just for selling the product. And in service businesses, tends to be the case. 0% dividend. So we don't have to worry about the dividend here.
Pillar number 3 is revenue growth over the past 5 years, Paul.
So revenue growth over the last 5 years, kids. Ready? 2 billion, 2.1, 2.16, 2.2, 2.35. Slow but steady. Check mark there. So
Okay.
It's not a fast-growing business. My guess is they're not doing many acquisitions because if they're doing acquisitions and they're only growing, they're growing very slow. Is that even 1% a year? That might even be 1% a year. I don't know. Either way, it's not very fast.
Pillar number 4 is revenue growth, Paul. Revenue growth.
No, profit growth.
I'm sorry?
Profit growth.
Whoop, I got them switched around. Profit growth. Go ahead, man.
So, profit growth, 365, 420, 453, 427, 307. Technically an X. They had very consistent profit here. Even going back the previous 5 years, it was growing. There might be a reason for this, why they're not growing as much, but it's an X, but not terrible, but it's something you have to do more research on, understand why it's falling. We are looking for a research analyst. If anybody knows somebody who wants to work about 10 or 20 hours a week, answering questions for me by finding the answers, that would be great. I don't like reading 10Ks. I'm done with it. I need to read them, but I need to have somebody read them for me and find information for me and Mo. Let us know. We're willing to pay.
Pillar number 5 is number of shares outstanding. We want this number going down, not up, Paul.
Okay, number of shares outstanding, 67.4, 64, 61, 60, 60.9. So it's a check mark. They did increase their shares from 19 to 20. Why? I don't know. But it's still a check mark.
Okay, how about current assets? Pillar number 6 is current assets greater than current liabilities.
Okay, this is a tech company. They tend to be pretty good. Current assets right now, 1.8 billion. Okay? Current liabilities, 1.3 billion. So $500 million left over. But here's a cool thing. They have 2.4 in total liabilities. So they're pretty close to having the cash on hand to pay almost all of their liabilities off. So that's pretty good. But it's still a check mark here because the 1.8 is greater than 1.3.
Free cash flow. Pillar number 7 is free cash flow growth, which is cash from operations.
We know how much I love
capital
cash flow,
expenditures.
guys.
This is a good one. Go ahead, Paul.
So we're going to go to annual.
Daniel, the app is not coming out for a few months still yet. I would say how many
9 to
months?
12 months, but there will be a website version in the next 3 or 4 months that'll be available. And guys, there's still a chance I don't even do an app because the more and more we try to work on being able to show long financials, it's becoming very difficult. So we might just have a website version or we do an app version. All it's going to be is literally the 8 pillars and that's it. That's all it'll be. It'll just be download this app, type in the ticker symbol. It'll tell you the 8 pillars and the check marks and X's and that's it.
That might be good. That's a good start, though, Paul.
It is a good start. I have a concern. Like imagine fitting all this data right here into an app screen. It's going to be very difficult to look at. I don't want to waste your guys' time squinting and being annoyed. And if you want to look at the stuff, I would tell you pull up a computer and look at it. But anyhow.
Go ahead, Paul.
You guys know how much I love free cash flow. So Seth, you ready?
Ready.
Okay, first one. Why am I drawing a blank here? 640, 700, 710. 710. Then 645 and 600. So X, it's decreasing. What's the average?
660.
So 660. Now everyone, we usually talk about multiplying by 20. This is a very slow growing company. Very slow. We saw about 1 or 2% a year. It's about 2% a year. No, probably more than that. It's 3 or 4% a year. The bottom line is it's very slow growing and they have decreasing cash flow. I don't like that. On this one, guys, I'm gonna be very conservative. I wanna pay about 10 to 12 times free cash flow. So I wanna pay between 6.6 and $7.8 billion for the company. I'm saying that off the cuff.
Do that one more time, Paul.
So remember, the multiple, we always talk about multiples of free cash flow.
Well, this is pillar number 8. This is our price to free cash flow. Slow it down
Yeah.
a bit. So we want to take the free cash flow.
So usually we multiply by 20. But we do that because if free cash flow is growing and the company is growing faster, you can grow into you have to sit there and give more credit to the cash flow by paying a higher multiple of cash flow. So if you have $1 of cash flow and you pay 20 times it, you're getting paid $20. If you pay 10 times it, you're paying $10. The higher the growth and the growing of the free cash flow, the more I'm willing to pay. This cash flow is decreasing and the company is not growing very fast. So I'm not going to be able to grow into a big number. So I want to pay a lower level, a lower multiple of free cash flow. So I'm looking at somewhere around 6 point, and again, this is off the cuff. I haven't read the 10K. I haven't done any research on this company whatsoever, what their competitive advantages are, what their disadvantages are, etc. So I'm sitting there saying 6.6 to 7.8, and they're currently selling for 10.
Yep.
So I need to pay about 40% less than what the company is currently going at. But I want you to keep in mind, if you guys remember here, let's delete all this. The one thing that's confusing me is let's look at the last 12 months free cash flow. So in the last year we had 600 million in free cash flow, but in the previous 12 months, it's 600 million in free cash flow. But for some reason, their PE ratio is this high. Now I want to pay about 40% less. That would take the PE to about 20, which is, for a slow growing company, not the best. But look at this growth, guys. I need to be able to get the growth from somewhere. This company has barely done any growing in the last 5 years. 2 billion to 2.35. If you guys want me to do the math on that one.
While Paul's typing, make sure you guys are smashing that like. You guys are doing a great job. And as always, subscribe. We go live Tuesdays and Thursdays. Oh, and Patreons. Remember, our patrons this Thursday night, 7:30, another glorious fireside chat with Paul and I at Paul's mansion. We sit down, uncensored, unadulterated, lots of cursing, Paul, lots of drinking.
Is it unadulterated?
I don't know what I'm saying. I'm just coming up with words, Paul. This is live. Cut the bull.
Well, you tend to do that.
And so join us Thursday, December 10th at 7:30. Paul, what number did you come up with over there?
So about what?
You were calculating something. I'm sorry.
Oh, it's about 3.5% revenue growth a year. That's nothing, guys. So we got to be able to figure out how we're going to get the money, and you have to pay a low multiple of cash flow. That's why.
You're not in love with this stock.
I'm not in love with the multiple. Listen, I don't mind slow growth. Everybody hates slow growth. To me, slow growth is fine because I look at it going, okay, well, I just realized that I'm not going to get big numbers. And if they happen to beat, great. But this is where the qualitative aspects matter. You have to go understand, can they at least sustain this slow growth? Why are they only growing at 3.5%? There might be a reason for that. You need to understand that.
Shall we move on to our next one?
Let's move on to our next one.
Jordan from LA. Jordan, I love you. I miss you. Tom also requested this one. This is AMD. Paul, tell us about this company.
So we've talked about AMD before. AMD is Intel's biggest competitor.
Advanced Micro Devices.
Okay, guys, let's look at this chart here just to start.
Uh-oh.
This is 5 years.
Okay, Paul.
This company 5 years ago was $2 per share. It's at $93 per share now. Look at this parabolic rise on the stock. Now, their market cap's $110 billion. Just 2 weeks ago, it was like $103 billion. So we're already growing at a huge number here. That is 13 times sales, okay? 13 times sales. Now, their biggest competitor is Intel. These guys are selling for 13 times sales. Let's see what Intel's selling for. 2.7 times sales. So the market leader is selling for 2.8 times sales. AMD is selling for 13 times sales.
What exactly do those two numbers mean, Paul?
So whenever you look at a good way to compare companies within an industry is to look at their price per sale, because in the same industry, they probably have very similar financial structures. How much profit they have, how much overhead they have, et cetera. So a way to look at it is to look at the price to sales ratio, which is basically dividing the market price by their yearly sales. And here it's almost 13. That's a huge number just in general, guys. So be apprehensive. Let's put it this way. If I sold my company today for 13 times sales, I have very little debt in our company on any of the operating businesses. It'd be worth $300 and some million. That's crazy. That's absolutely, I don't know many companies who can get 13 times sales because unless their bottom line profit is 50%. So it's already screaming to me based on this chart and based on 13 times sales that this is a massive bubble and probably somebody's paying for, they probably had some big news and built momentum and all of a sudden they jumped up. So
pillar number one is PE ratio. Want this less than 20? I can see it's pretty bad, Paul.
It's 125 right now, guys. The PE ratio is 125. So this is already showing 6 times more. Now again, keep in mind, if you divide by 6 times, your 13 times PE, price of sales, becomes 2.1 or something like that. Intel's is 2.8. Do you see what I'm saying? It starts to come back together and look a lot more reasonable.
Jacob, I see you there. Thanks for the great comment. We will get to iRobot later. It's a tech company. And Paul, we have a new patron. Husky just joined. I assure you, congratulations, my friend. You would learn a lot in the Discord channel, and it's going to really change your life. It's changed mine over the past few years. Paul, let's keep going. Pillar number 2 is profit margin. How are they doing?
Okay,
I would
so
assume.
their profit margin here, 14%.
That's okay. We want it above 10, right?
Yeah, so we're a check mark here. And their gross margin is 44%. Okay, not bad. Let me do this. Let me pull up Intel every single time. Let me pull up Intel, because I like Intel.
And you like comparing, of course.
And I like to compare, so let's compare these two guys. Ready?
Please take one moment, guys. If you like what you're seeing, all the cameras, all the Y charts, Paul's knowledge, all we ask is a simple tickle that like button just below, thumbs up pretty please. We got 66 people watching, Paul, and only 40 likes. Come on, folks, I love you.
Come on, losers.
Oh.
All right, Intel's guys,
Losers.
their profit margin is 23% at the bottom line, 53% in gross margin. So
better.
Already Intel has a lower PE, lower price of sale. And guys, it's one thing if it was marginal. If it was very close and AMD had more growth potential, I'd probably side for AMD. But you're already paying many, many times more than Intel. So unless you think Intel's going to 0 or going to drop by 50 or 80%, I don't get these numbers. And for Intel to drop by 50 or 80% would take years and years and years and years and years for that to happen. So I'm looking at AMD automatically. By the way, I can already tell you right now, AMD is going to be a no-go. But I want to go through the process to show you, okay?
Keep going.
Let's go to the...
Pillar number 3, which is revenue growth over the past 5 years.
All right, great. Revenue growth. Now, revenue growth here is pretty good. 4 billion, 4.3, 5.25, 6.5, 6.7, check mark. And I want to know how much of that's from their own growth versus acquisitions, because I'm sure a company like AMD is trying to grow like crazy. Net income. Ready?
Pillar number 4, which is profit growth, Paul?
Yes.
Go ahead.
Lost 660, lost 500, lost 33, made 337, made 341.
They're making money, Paul.
I will give them credit, but look how long they lost money for. Look at that. They lost $1 billion in 2012. That's a lot. So they are making money, which is good. More power to them. Check mark there.
How about shares? Pillar number 5 is number of shares
Oh
outstanding.
boy. 783, 835, 952, 982. They love issuing more shares.
Oh boy.
You know why they're doing that? Because their stock is skyrocketing. Tesla just announced it today. Tesla announced another $5 billion stock sell because their stock is so hyped, they need to take advantage of that. So when your stock is skyrocketing like crazy, one way to take advantage of it is issue more shares that people want, and you're going to put that money in your coffers instead of issuing debt. You're going to, and you guys as investors don't really look at this number.
I was going to say, how many people actually know this is happening behind the
Nobody.
scenes?
Nobody
it's
knows.
like a random news
But
article.
this dilutes you out of, so now, going back, if you own a share in 2005, your shares now buy about 20 or 25% less than they did before. They own about 20 or 25% less than they did before. But you might sit there and say, yeah, my stock has doubled. More power to you.
RJ, I see your comment there. Allstate. He's asking for Allstate. I'm imagining.
I don't do insurance companies.
We probably won't get to that. Yeah.
I don't do insurance companies.
Should we keep going, Paul, on AMD? Or you just...
I want to. Let's keep going.
Okay. Let's do current assets greater than current liabilities. This is pillar number 6, baby.
5.5 billion in current assets. Current liabilities, 2.4. Excellent. And I will say this, guys. They only have $3 billion in total liabilities. So 5.5 greater than 3.15. They have about $2.3 billion left over. So you can take their $110 billion market cap and take 2% off of that. Congratulations. So it's still a very positive thing. It's hard for companies to go under when they have more cash on hand than liabilities, which is a great thing. It's a major check mark. I love it.
And the final, this is free cash flow, Paul. Pillar
All right,
number
let's
7,
do this,
the big
kids.
granddaddy of them all.
The big daddy.
Pillar number 7, free cash flow growth.
Are you ready for some numbers?
I'm ready.
I'm going to ignore year 4. So we're just going to do, so 4 million. This is bad. Let's just go off the last.
What's wrong, Paul?
I mean, they have no free. They have 1 year of free cash flow before this year.
They don't make money?
Free cash flow is not there, guys.
Uh-oh.
Let's go to their trailing 12 months. How much money they make in free cash flow? Oh, wow, big one.
Okay.
Yeah, so they currently make about $700 million in free cash flow. So guys, They were a $110 billion business,
Oh, look at those zeros. Oh, keep going.
and they made $700 million in free cash flow. Steph, do that ratio for me real quick.
I don't know how there's too many zeros.
Just do 110 divided by 0.7.
Divided by 0.7, good lord. It's a 157.4, 157.1, 157.
So their price to free cash flow is 160.
We want it to be less than 20.
We want it to be less than 20.
The price of their stock versus the free cash flow they have.
Every dollar of free cash flow, you got to pay $160 to get. So if you give me $160 today, every year I'll give you $1 back. Good investment or bad? Now, are they growing a lot? We saw that they're growing. Are they growing their net income a lot? Yes. Their revenue has doubled in 5 years. But remember, guys, just because if the free cash flow doubled again from here, you're still only at $80. 80 times free cash flow. Double again, 40. Double again, now you're at 20. This has got to go up 8 times. Your profit, the free cash flow has to go up 8 times for them to get there. So if their free cash flow is $700 million, we need it to be times 8 to get it is $5.6 billion. Guess what, guys? How much did they do in revenue last year? $6.7 billion. So let's do this example. Right now,
Go ahead, Paul.
right now, they made about 10% of their money to free cash flow. We need them to have $5.6 billion in free cash flow to justify today, to be 20 times free cash flow. So what does that mean? We need sales of $56 billion. They did 6.7 last year. We need sales to go up by 9 times.
Oh, boy.
How long does it take to go up 9 times? Let me do it this way. If it took 10 years, so let's say you bought the stock today, and it took 10 years to get to $56 billion in revenue. 10 years. That means the company has to grow by 24% per year. Last year, they grew by 5%. So it's got to do 24% a year for 10 more years, year in, year out. When was the last time they did 25% in a year? When was the last time?
Oh, boy.
I'll tell you what, guys. In the last decade, it hasn't happened. Nope, hasn't happened once in the last decade.
Oh, boy.
Has not happened one time. This is why I was looking at this one. I was doing my mental math real quick. So do you guys understand what I mean by looking at the cash flow and the numbers? To pay today's dollars, assuming they never issue any more shares, which we've seen that they're addicted to that, you've got to have $56 billion in revenue. They're at $6.7 billion in revenue. So if it takes 10 years to get, hell, if it takes 20 years to get there, that's still 10, 12, 15, I don't know what the number is. They haven't done that in the last 10 years. In fact, in the last 10 years, they're almost even. They did 6.5 billion, now they did 6.7. So they need to do 9 times more revenue to justify today. That means if you bought today, 10 years from now, the company's worth what you paid for it. And it has to grow 24% a year, which it hasn't done
In the last decade.
well, let's even see before then.
You might be beating a dead horse here, Paul. Even the people in the comments are like, yeah, we're not touching this.
Good. By the way, even the last decade, only one time, right there. And I bet you they did an acquisition there. All right, guys, I think we get the point.
He is fired. What is your heart rate right now, Paul?
I'm not fired
You
up.
get fired up about this.
I love talking because this gets me so
I
excited.
know.
It shows people in the numbers how ridiculous it is. Just like when I wrote about Tesla being bought, you could buy 5 companies that were amazing for Tesla and compared to Berkshire Hathaway. People were like, holy cow. I'm like, yeah, that's kind of the point.
I can feel the heat coming off your undercarriage from here. Let's move on.
These glasses make my head hurt.
NVIDIA is the next one. Jordan and Tom again, our patrons. Love you guys. NVIDIA.
NVIDIA is pretty awesome.
Yeah, you like it? What do they do?
I mean, they have great graphics cards, right? Is that what they do?
Yeah, I think so.
Yeah. Leading out of graphics. They've been a leader for decades. So let's look at NVIDIA.
All right, what's the market cap, baby?
Well, let's first look at their stock price.
No, you never look at price. Oh, I see. You see
Look at this.
crazy rise.
Actually, they're one of the companies that did well during the tech bust. Holy cow.
Tom says he wants a Paul heart rate monitor in the bottom right corner of the screen to see how fired up you get about this stuff.
347.
I'll tell you what.
I'm having a heart attack.
I'll tell you what, Paul. It is just from a normal person sitting here, guys. As a viewer, I know this guy goes pretty fast, and I try and slow him down. But I'm learning along just with you as I sit here and watch this guy. But just the fact that you use all this math is quite different from all the other videos I see, Paul.
Well, of course. And by the way, some people like the math, some people don't.
Right.
I look at it going, the math to me tells a story. It's not the full story, but it makes me immediately eliminate a company. When we looked at AMD saying, okay, if I just took out the name AMD and said, where would I need to be for me to pay $111 billion for a company? I sat there and said, okay, I got to have a $56 billion in revenue based on this kind of profit margin, et cetera, et cetera. Even if you assume their profit margin increases and goes to 20%, you still have to generate $35 billion in revenue, which would still take 15% a year for the next 10 years. And I'm like, they haven't done it before. Why do they do it suddenly now? Could it happen? Absolutely could happen. Is it probable? No. If you invest in 100 AMDs with the same story and the same numbers, you're going to end up having a hard time making above average return. That's the whole goal.
Leo, I see your comment in there. Thanks for joining us. We're probably not going to do banks today. We're trying to stick with techs just at the moment.
Well, we're still learning banks, by the way.
Yeah. So, Paul, keep going. Let's. What is the
NVIDIA.
market cap for NVIDIA?
So 330 billion.
That's a lot.
Big company, 88 PE. So X there. So big PE. By the way, if we thought, look at this price to sales, 23. If you thought Intel was bad, look at that one. And look at these guys. Look at this profit margin. Oh my lordy. That's huge.
That's good stuff.
Yeah, that's like Microsoft type stuff with a 62% gross margin. Ironically, their gross margin is lower, but they have a great profit margin. So far we have 1X on PE and one profit margin. Look at this dividend they pay.
What is it? What is it, Paul? 0.12?
Hey, NVIDIA, keep your money. Jesus Christ. What the hell is that? 0.12%? Like, just keep the money. It's not even worth processing the paperwork.
Pillar number...
Jesus. I love it.
Pillar number 3 is
Can we write
revenue.
a suggestion? Can we go to the suggestion box and write into NVIDIA, please stop sending us dividend checks for 4 pennies for every share we own. Thanks.
It costs them 49 cents to mail it to you.
Yeah, exactly.
Revenue growth over the past 5 years, Paul.
All
Revenue
right.
growth.
This company's doubled, over doubled. So I wonder how much of this was acquisitions, because you see right here, big jump from here to here, from here to here, big jumps, guys. So, actually they're down from 19. Why is that? So that's a little alarming. So they went from massive growth to all of a sudden falling. Let's see how they've done the last 12 months. In the last 12 months, they've done, they're up oh my God, they're up a lot. Did they buy anything? Does anybody know they bought anything? Because in the last 12 months, they've done $14.7 billion. That's a big number. All right, either way.
Did you ever get to profit? No, profit growth?
Right here.
Go ahead.
614, 1.7, 3, 4.4, 2.8. Check mark. Again, it's down a little bit, but still growing and growing by a lot. They must have done some acquisition because, their profit almost tripled in 1 year. They must have done something.
Number of shares outstanding. We want the number of shares going down.
And just like our friends at AMD, it's up.
Oh, boy.
Just like our friends at AMD. That's all right. I understand. They're making a lot of money. The stock's up a ton. They probably want to issue more shares.
Current assets over current liabilities.
I bet you this is going to be really good, guys. Current assets, $14.4 billion. Current liabilities, $3.7. Total assets, okay, guys. We got ourselves a winner here. We got the major check marks. They have way more cash on hand than all liabilities. So the chance of these guys going under is greatly decreased when you have more cash on hand than all your liabilities. So to everybody out there who wonders, that means your checking account can pay off your house, your car, your credit cards, your student loans, every debt you can imagine. You have the money in your bank account to just write that check. Okay, so it's good. Now let's go to free cash flow.
Free cash flow growth. This is pillar number 7.
You have your calculator out, my friend?
I'm ready, baby.
Are you ready, though?
Well, I was reading an article. Go ahead.
An article?
Go ahead.
All right, you ready?
Yeah, I'm ready.
All right. I'm going to focus on the last 3 years. And the reason being, guys, is they made some acquisitions here. I'm just going to focus on the last 3 years. I think that's fair. So we're talking about $3 billion, $3.1 billion, let's call it $4.3 billion.
Divided by 3?
Yep.
3.5.
So 3.5 times 20. They're growing. 70 billion.
Market cap of 380?
And then 330.
330.
This is 330. So guys, we need to fall by 80%. It's a big drop. But you know what? Look at their PE. If we go back to their PE, what was it? Look at that. 88. What's 80% lower? It's 17. Okay. That's just it. So we have growing free cash flow. There's a check mark there, but the price of free cash flow wasn't there. And the other thing is a lot of shares increasing and revenue increasing fast I bet they're doing acquisitions. I don't like acquisition growth as much as I like organic revenue growth. Organic revenue growth is, this is the company by itself. Without adding more companies, they're still generating more and more revenue.
I'm going to give Paul a break from going crazy. Guys, we love that you're smashing the thumbs up button. That's incredible. We appreciate that. Again, you don't have to pay us anything for these live streams. Just tell YouTube to give us some money for all this. That's wonderful. And you do have to pay for the Patreon, but if you look in the comments, a lot of Patrons in there, and they're praising it. They're getting a lot of knowledge.
We got another one.
Yeah, someone's saying they basically have access to their personal finance advisor right here and there. And I guarantee this guy knows
we
more.
got two so far this live stream.
That's very nice, Paul. I love you.
Why are you saying that?
No, because I'm trying to talk about something. I love you.
Oh.
Paul, we prefaced the idea of Cisco and their new acquisition. Perhaps you should mention that and bring that up.
What do you mean?
The title of this live stream is Cisco Makes New Acquisition. What did they do yesterday? Don, what happened? What did they do, Paul?
What do you mean?
The thing I texted you about for about 15 minutes last night?
Oh.
IMImobile?
Oh, yeah, the mobile thing. Yeah, that's right. I'm sorry. I just got notification OSU Michigan's canceled. We didn't lose this year, bitches. We didn't lose this year. Suck it. Suck it, suck it, suck it.
And we just lost monetization on this video there, Don. Okay, Paul. So great spoiler by us. Let's go on to the next company, Paul. This one is a rare company. You've never heard of them. It's called AAPL. Apple, yes.
So guys, Apple's interesting because they're not as they for a while there they were selling it. I remember a few years ago, probably 4 or 5 years ago, a friend of mine messaged me who was a day trader. He said, "Paul, fundamental basis, what do you think of Apple?" I go, "Insanely awesome." It was selling for like 11 times earnings, amazing free cash flow. My comment back was, the only qualitative thing I worry about is, can they sustain that growth? Because they were like the number one in the world, but it was an amazingly inexpensive company. And now, look what's happened. It's become expensive.
Let's go look at it. You're getting more watch love, Paul. They love the blue watch with matching your blue tight pants. It's just incredible. Are those Sherpa on the inside of those pants?
What was that?
Sherpa. That's the new thing now. It's like the pants have like a lining inside.
These are I have shorts underneath there.
Oh, okay, of course. Paul's super shorts. Okay, keep going, Paul. Let's go. What is the market cap of Apple?
$2.1
gajillion? Okay.
Trillion dollars, guys.
2.1. Now,
trillion.
Now, you're not even a big fan of Apple, but how many Apple devices do you own?
No, I'm a big fan of Apple.
Oh, okay, but
I prefer PCs.
Right, you prefer using them, yeah.
Yeah, like I for some reason I have much better luck with PCs.
I've heard people say like, don't drink the Apple Kool-Aid. I was actually like, I had a realization. I was somewhat against Apple, and I still had like 7 devices in my home.
Why were you against Apple?
The drinking the Kool-Aid type thing, maybe it's like a cult following that other places. I mean, I don't know of a Microsoft cult following, like.
Except for the entire world who uses Microsoft.
Yeah, but they're maybe not as passionate, right? Like.
Yeah, sure, but Apple's a very people are really, look at Don. Don loves Apple, right? And I like my Apple computers too, but I find that for me working, I can work better since I'm not a designer, I can work better with Excel and other things on my numbers using a PC. For some odd reason, it's much easier for me. So that's why I use it.
Husky says, I wish I wasn't so young with no money, or he would have bought more Apple. Of course, we all wish that. I would say, Husky, you're in a unique position now that you're a patron, in that you're learning young, which I wish I would have done like a long, long time ago. So
guys, like I said, for the Patreons, this is exactly why you need to sign up. Literally $8 a month. It is 28 cents a day or something like that. And you're gonna get the app for free, and you get more access to us. And like tomorrow, Thursday night, we're doing a live fireplace chat.
Fireside
only
chat,
patrons.
Yep. Yeah,
that's it.
Patrons only, yep.
Okay, so anyhow.
Apple, here we go. Market cap of 2.1 gajillion. And what is the PE ratio, Paul?
So now it's expensive. It's 38. And this does matter with Apple because they've always been making a lot of money. So it's not, I don't look at this thing to myself, well, maybe they had a big write-off. No, this is Apple. They make a ton of money. But look at price to sales, only 8.
Only 8.
Versus 13 for Intel and $1 billion for NVIDIA.
Profit margin for Apple.
19.6%, check mark.
Very good.
Yeah, these are good because hardware companies tend to be lower margin. And they're trying to transition their business to more subscription type of revenue coming in, which I like a lot. And their goal is to immerse your life in Apple. Now, they are very difficult in the App Store, as we're finding out with, what's it called? Oh, another great dividend. Thanks for the 0.66, kids.
So lovely.
Appreciate that.
Pillar number 3 is revenue growth over the past 5 years. I'm guessing it's always awesome.
Yeah, it probably is. So annual revenue growth, 215, 230, 265, a drop here, 275. Massive check. And the best part is, They were 108 billion in 2011, and now they're 275. I mean, that's
amazing.
And they've done acquisitions, but nothing to material. It's all driven by iPhone, iPad, and probably all their sales from their app store and all that stuff.
Yeah, the iPad has just been such an incredible device.
Yep.
I know the NFL, they're doing the Microsoft tablet. And I remember one NFL game, like the quarterback is on the sideline on the tablet, and he's like, well, he's over there on his iPad. Like, like it's so immersed in calling that, like it's just incredible. What's up?
Can you explain PS, price to sales? Social Dancers is very curious about this.
Okay, price to sales, guys.
Thanks, Social Dancers. Thanks.
It's something I added. So price to sales, and
She's
I'm only
from
using
Toronto, Paul.
The only reason I'm using this is, let's say the market cap is the price. So it's 2.1 trillion, and the sales is their revenue. There's no generic number. Like the auto industry, they sell for like 0.4 times their sales because there's such low margin. The bigger the margin, the higher the price to sales because you can make more money on those sales. So price to sales is just a way of, I use price to sales to compare companies within certain industries because everybody should have very similar economics within them, overhead costs, operating costs, sales costs, etc. I don't like to look at them across different industries. Like I'm not comparing Apple's 8 times to GM's 0.4. That's an unreasonable a comparison. But it's just a way to compare companies within it. It's just the market cap divided by the total revenue per year. That's it. It's not like in the market, the stock market completely is like 2 times or something like that. I don't know what the exact number is, but it's like 2 times sales. So it's just a way of looking at, all these metrics are, in and of themselves, are useless. But put together and look at the whole, you can start seeing stories and ways in which stocks are going.
Caesar, we did Dropbox last week on one of our live streams, and we will have a small video. It's a definite pass for Paul. Let's do Paul. We're back on Apple. Revenue growth is pillar number 3, baby.
45.7 to 57. Check mark there, kids.
Profit growth is pillar number 4.
Check mark. We already said that.
Oh, we just did profit?
Yeah.
I thought it was just revenue. Sorry.
Revenue is also a check mark.
Oh, great. Let's do
number of shares outstanding.
Number of shares outstanding, pillar number 5.
So, guys, my guess is Apple's going to use a lot of their free cash flow to buy a lot of shares back instead of paying a dividend. Oh, and by the way, because it is a better way. It's a more tax-effective way for Apple to give money back to their investors. By the way, the one thing I want you to note, if you're going to do more research on Apple, figure out how much their sales have been changing over the years from hardware sales to subscription and software and their subscription sales. That's more important to me because I get worried about the hardware world. Plus the subscription and software world is much more higher margin. So that's something to keep in mind when you're looking at things. But this is an X here. I mean, it's a check mark here on shares outstanding.
Let's go current assets greater than current liabilities, which is pillar number 6, Paul.
All right. I bet you this is awesome.
Yeah, right, of course.
Quarterly. Oh, my Lord. $144 billion in cash and $105 in current liabilities. That's $40 billion less. $40 billion more current assets to current liabilities. So that's a check mark there, a massive check mark.
Free cash flow growth, Paul, over the past 5 years.
All right, Peanut, you ready?
I'm ready.
Are you, though?
I say I'm ready, but I'm almost ready.
Okay. So 54, 52, 64, 59, 72, 73.73. So that's a check mark there. What's the average?
60.
Times. Now.
Is this millions or jillions?
Billions. This is billions.
Oh, jeez Louise.
So with $60 billion a year, imagine how many companies they could buy a year just in cash.
$60 fulfillion, Paul.
So now the question is what multiple? Let's keep it at 20. And here's why I'm keeping it at 20. The growth going forward will probably not be as good as the past, but they're such a big company, it's going to be so hard for people to disconnect themselves from Apple life. Nate, what kind of computers do you have?
Windows.
Oh, do you?
Yeah.
Do you prefer that?
Yeah.
Excellent. F off. So if it's 1.2 trillion, it's currently at 2.1 trillion, it needs to drop by 40%, call it's actually 45%, and the stock's currently at 135, so we need the stock at about, what, 80 bucks? So I'm a buyer of the stock around $80, or that's what I think the value is for the company, about $80 a share. All right, so.
When was the last time it was that?
$80 a share.
And would you like to bring up momentum for Apple?
We will. $80 a share earlier this year. It started the year at $73 a share.
Daniel asks, do you see growth in Apple future with the new president? I don't know what plans.
I have no idea. I don't like trying to make those assumptions. I have no idea what the new president's
Good
going to
answer.
do.
Keep going.
He probably needs Apple to remember what's going on in his life. I have no idea. I was just trying to bring that up.
Yeah, great. I'm tuning you out already. So are our viewers. Oh, no, it's reversed, Paul.
Somebody pointed out, somebody paused in the Patreon group, somebody paused one of our videos, and I was going like this. And they said, Paul pulling out his inner Trump. I was going like this.
That's because you're a racist. Let's keep going, Paul. Next one. Should we keep? You want to look at momentum?
We doing, momentum?
Yeah. Where did it cross over, baby?
All right, guys.
Now, before tell folks what they're seeing with this graph. We have some new viewers.
Another way to deploy your capital and get some returns is do what's called momentum investing. Trader Mo and I did a back test over 20 years on a handful of like 75 stocks, and we found that when you buy, when the 200-day moving average, that's the average of the last 200 days of the stock price, goes above the 300-day, and then you sell it when it crosses back below, then you beat the market by about 1.2%.
Ayrton, one of our patrons, said you're only racist against overvalued stocks.
That's correct.
That's very disciplined of you, Ayrton. Good job. Okay.
So it crossed back at the end of 2019 at around $60 a share. If you'd bought then, you'd about double your money right now.
Wow.
You'd over double your money right now. So it works, and sometimes it doesn't work. Because look right here. If you sold right here when it went below, you sold at 50, and then you bought back up at 60. So you would have been waiting here. And then, so it all depends. I mean, going back further, you'd been more money. But Apple's also been on a complete uprise. I don't like using Apple because that very rarely do companies do this kind of growth.
Swizz Deets wanted to see Shopify, Paul. Should we look at Shopify?
Sure. Something tells me it's going to be really bad.
Yeah, but we thank you, Swizz Deets, for being a patron. Of course, swizzle my nizzle.
Swizzle my nizzle.
And as always, guys, make sure you're smashing that thumbs up. Just give it a little tickle, pretty please, whether you're on a mobile or a computer. How many out there are on a computer? I would say most would probably be on mobile. So yeah, give it a little tickle. We appreciate it.
Holy cow!
What's that, Paul? This is Shopify. Pull it up. Let's see. Show people.
135 billion. Price to sales 54. Price to earnings 701. Do we need to go any further?
PE of 700.
PE is 700. It made $196 million in the last 12 months, guys. 196 million bucks. It's selling for $134 billion.
I think you almost made $196 million in the last 12 months,
exactly.
Paul. And you're not. Are you? You're not worth $135 billion.
No, I'm not, guys. I don't think we need to go any further. I hate to break it to you. I mean, they got great margin. They got great margins. Really awesome. But this has got to come down so much, it's ridiculous.
Why is your stance in this, Paul? Because other people say this is growing, this is incredible, this is
Great,
amazing.
okay, let's go look at the growth.
Let's just get on this. Let's get in on this stock before it becomes $1 gajillion.
I can't, though.
You can't.
Guys, it doesn't even make money in the full year. This is the first year it's made money. In the last 12 months is the first time it's ever made money. Do you see this? It lost money in the full year last year. It just started making money. So let's do it this way, guys. Let's do it this way. It's a $135 billion company.
Paul, would you say that probably half of the $100 billion companies out there aren't worth that?
I don't know what the number would be. We have to look it up.
Interesting.
Let's do it this way. Is there a way I can get this to be white? Like a blank screen? Okay, $135 billion company. If their profit, let's say their profit goes to 30%. I'm going to give them more profit. They're currently making 25% profit margin. Let's say it's 30%. Okay? That means that let's do it this way. Okay, so PE ratio. Let's pick a PE ratio. Let's give them a high PE ratio of 30. Let's say we're going to give them a 30 PE ratio. 30. They're currently at 135 billion. 135 billion divided by 30 PE. They have to make $4.5 billion a year. Is that right? That's right. That's a pretty straightforward one. Yeah, 4.5 billion a year in profit. Not sales, and profit. Keep in mind, their sales last year, in the last 12 months, are 2.5 billion.
What's their profit margin?
So their profit margin, let's say it's 30%. It's at 25 right now. I'm going to give them a little bit of benefit. Let's say it's 30%. So in order to make 4.5 billion, you have to divide by 0.3, and that means, what's 4.5 divided by 0.3? Divided by 3 is 15 billion. Mm-hmm. They have to have 15 billion in revenue.
Hold on. They need that
to justify
the price.
Assuming a 30 PE still. I was even giving, this is what I want to do, guys. I'm trying to show you guys higher profit margin, higher PE.
This is assuming a 30.
A 30 PE.
This is a 700 PE.
Right now it's a 700 PE. I'm just assuming, let's just call it 30 PE, which is still way high. Mm-hmm. They have to have $15 billion in revenue. How long? They're at 2.5 right now. Let's say it takes them 10 years. 15 divided by 2.5 to the power of 0.1 minus 1 equals, anyone want to tell me? This is the math to figure out what it needs to be.
No one's going to tell you, I assure you.
So 15 divided by 2.5 to the power of 0.1. They need to grow by 20% per year for 10 years. Is it possible? Yes. But that would just mean it's worth what it's selling for today. And it's selling at a 30 PE, which is still not worth what it's worth for today. I was still giving more and more. Do you see what I'm saying here? I'm sitting there saying I'm giving a higher PE than we normally give. I'm giving them more profit margin than they've made. And I'm telling them how much revenue you have to grow by for the next 10 years to justify today's price. Not 10 years from now's price, today's price. And that's where I have an issue with growth investing. Everybody always puts more value on growth. When you break it down to the numbers, you sit there and say, is this a probable outcome? 20% per year is okay. It's a small company. It could grow 20% a year all day. I'm fine with that. Then it's worth what it's worth today at a 30 PE. Let's call it 20 PE. At a 20 PE, you need 7.5 billion, 30%. I'm gonna do the math real quick. We need $23 billion in revenue so we need 10 times over 10 years.
Make sure you're smashing the like.
We need 26% growth a year to justify a 20 PE.
Oh boy.
For it to be worth what it's worth today, what we're buying it for today. That's the issue, guys. It's not a matter of, is the company growing or not? Of course it's growing. It's, what does it have to grow to justify the price you're paying today? All the future is the present value of all the free cash flow. That's why I'm glad we did Shopify, because we got to start doing this more. When we find expensive stocks, we got to figure out, let's make our assumptions. 10 years, 26% per year, 20 PE, it is worth what you paid for it today. It is worth this today. And what can happen in the next 10 years, guys? A lot can happen. You never know what's going to. That's the point of value investing. The point of value investing is make reasonable assumptions, and it comes out to a price that's way higher than it is today. That's the point of value investing. Intel, I think, is an example. I'm making reasonable assumptions with Intel, and I think it's worth a much higher price than it is today. That's the point. So anyhow.
There's a 10-year-old boy watching the channel here, Paul, and he's got a little stock money to burn. Where should he put it today?
In an ETF.
Really?
I love the ETFs, guys. I love it for saving. Just save your money. Save your money and then take a portion of your money and put it into stocks, individual stocks, to have fun with this. But overall, for your savings, don't sacrifice your retirement while you learn. Get your retirement money going. Get that money in there. Put it in an ETF. It's going to go down a lot. It's going to go up a lot. But the point is, you're not going to think about it, and you're going to beat that stupid financial planner who's trying to bilk you of fees. That's it. Uncle Paul's doing it for free. Join the Patreon, though. Pay me a little bit of money back, and we'll be good. And I can pay Don and Tim did get a raise recently because of the Patreon.
Paul, my son, we did a compounding calculation yesterday. He's got about $3,200 saved, and he's investing it. We did just a standard. He's got 55 years before retirement. So even $3,000 with an annual increase of only $2,000, he was at like almost $6 million, Paul. Compounding interest.
Wow,
it's incredible. So my children right now, if you have children, and some of our patrons do, my children right now, Paul, every cent they get from anything, Christmas, everything goes into the stock market.
Kids.
They're incredible. They've stopped asking for toys.
Come on.
I'm telling you, they just got money for Christmas, and both of them, my 7-year-old put it right in there. Gio will make $130 in a day.
Tell them to enjoy a little bit of life. Tell them to splurge a little bit.
I think they are. I think that they're enjoying seeing.
And I want them to realize that, Gio, I want you to realize that stocks will go down a lot. You just haven't seen it happen. So you have to be okay seeing your $1,300 becoming $1,600 and not get upset about it and say, okay, Uncle Paul said this. It'll be okay.
Paul, I think on Thursday, Don, let's go over a full ETF live stream. Paul, we really need to walk through. That's a great comment, Lewis. I see you there. That's a great comment. We always talk about these are the safest, best bets for your money. You can play around with some of these stocks that Uncle Paul talks about, but great ETFs is a great start, and you can get a hold of your own finances and manage your own wealth. And Paul, let's do that on Thursday. Just a complete breakdown of what you think with ETFs. Great comment, guys.
Okay, John Thiesing, our boy, wants us to look at NetApp. So I brought up the chart from NetApp from 2000, okay?
Look at that rise.
In 1998, it was $3.80 a share. It got as high as $148 and as low as $7.55 just 18 months later. Now, the high was $148.
What was the low again? I'm sorry.
$7 and some cents. The high was $148. What's it selling for today?
Don't ask me. $60?
$60, guys.
Why do you show this, Paul?
I show this to say, who would have ever said that it would go to 148, and they probably said, yeah, so maybe it goes to 100. But when it's overpriced, it gets killed.
Well,
it
Paul,
fell 90.
I'm sorry, you bring these up so often. When you look at it now, like after the fact, but I really love when you hide the fall. When you hide the fall, it looks a lot like that parabolic rise looks a lot like these hyped stocks. And so like after the fact, like, oh yeah, you know what I mean? Someone should have known, but it's just interesting that for people out there that want to just keep following the hype, that, yeah, there you go, Paul. Look at that. Oh my gosh. And so you sort of train people on like, you're not going to be the first one out, right? When you see this huge rise, you think you might be, I think I'm going to be the first one out, right? Why don't I just buy it? And when it goes skyrocket, there you go. Look at that.
Oh, it only goes to $84, and then you go 3 years later, a year and a half later, and it's down to $7. $7. And guess what? If you bought it at $7 in 2003, you're up 9 times in your money since 2003. Not bad. That's really good.
Mm-hmm.
Okay, but you wouldn't have bought because you just said you have no reason to buy, so you have no reason to keep it. Look at this. Look at this plummet, guys. This is insane. Went back to $10 a share in 2008. When as high as, even at its peak recently, it's only $85. We only have 6 minutes left. What are we doing here? 74 likes? Come on, people. So, let's look at this company. Is John Thiesing on right now?
I think he had to jump off. Do you want to skip it?
No, let's do it.
Okay, go ahead.
Okay, guys.
What is the market cap for NetApp?
13.6.
Okay, 13 bill.
PE, barely a check mark. It's 19.98. Price to sales, 2.5. Okay, so some good stuff here.
How about profit margin?
Profit margin is X, 9.7.
Oh boy,
very
close,
good
though.
gross margin.
Okay.
And a 3% dividend. Not bad.
So we're still at XX though.
Yes. No. Check on the PE.
Oh, PE,
it's
yeah.
barely a check.
Great. Okay.
So, 3% dividend on $13 billion. They spend $400 million a year on dividends.
Revenue growth.
$13 billion times 3%. One other thing.
Sorry, Paul.
NetApp is a leading provider of enterprise data management and storage solutions. The company has 3 operating business units: are product, software maintenance, and hardware maintenance. They transition from data center, blah, 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 blah. Okay, they have 10,000 employees.
Are they allowed to say they're leading provider? Or is that just a nice,
It's a generic
catchy
thing they
adjective?
just
Yeah,
say.
I was going to say, are they leading or are they just saying it?
Who knows?
Pillar number 3 is revenue growth. Revenue growth for the past 5 years.
5.54, 5.49, 5.9, 6.14, 5.4. So decreasing, guys.
Oh boy.
So how's this going to affect me? When I see decreasing revenue, does that mean I don't want the company? No. It just means my multiples of earnings and free cash flow have to be a lot lower because I'm not going to be able to get the growth out of it. I have to make my money only in cash. I'm not going to get the growth. I have to pay a discount in order to make my money. So just keep that in mind here. I'm not a no because it's going down in revenue, because it's been going down in revenue for a while now. But keep in mind this, guys. When it was selling for $144 a share, it did $1 billion in revenue. $1 billion. It's now doing 6 times more, and it's selling for less than half the price. That's what I mean, that value eventually matters. And by the way, this is one of the companies that actually made it. This is the company that actually made it. And look at their growth, by the way. Look at their growth. So you told me look at this. 1996, 47 million, 93 million, 166 million, 289, 579. Paul, it's up 10, 11, 12 times in 4 or 5 years. This is going nowhere but up. And it peaked at 148 and still continued to grow, by the way. It's still growing. $1 billion, then it fell, grew, kept growing, and still hasn't equaled the price it did in 2000. If you don't see this, I want you to do me a favor. If you don't understand this concept.
Careful, Paul. Now I know.
I want you to go to your car.
Paul.
I want to open the door. I want to put your head in between the door and the frame.
Be careful.
And I want you to slam the door into your head as many times as possible, like this, like so.
I try to urge him, folks, to keep it clean.
And then,
if you join,
I want you to close the garage door, take the key, put it in the ignition, start the car, and go to bed. Because if you can't understand this, now I'm not saying it's always going to happen, but this is one of the companies that actually made it. This company actually succeeded and actually stayed around, and they still fell. Forget about the companies that didn't even make it and went to zero. What are the comments now about my comment?
I did, they do love that, but
LOL.
I just got to keep it clean. Now, if you want more of unclean Paul, join the Patreon and join us, folks. I love you guys, our patrons. This Thursday night at 7:30 p.m. in Paul's mansion, we'll be there doing an uncensored look. We'll take all of your requests, talk about anything, and yes, Don, I'm really loving ETF live stream on Thursday.
That escalated quickly.
Folks, yes, social dancers, correct. Folks, I'll tell you this. I brought up Weeble to Paul yesterday, and
2 days ago.
2 days ago, I was arguing with Paul that we should be pushing Weeble, and within 30 seconds, he brought up religion.
And he said, like, I don't get the reference. I'm like, and I literally was like, how do you not get the reference?
That's how fast it can get with this guy.
It wasn't 30
quickly
seconds.
if you get on his wrong
it was
side.
5
So
minutes.
okay, keep going, Paul.
All right.
Do we need
Profit.
to keep looking at NetApp?
I mean, if you want to.
I mean, it doesn't sound like you're liking
Oh,
it.
no, it was 20 times. No. Remember, we're talking about the past then. We didn't like it.
Okay. Oh, that's right, Paul. Thank you so much then.
All right. Profit 230, 481, 116, 1.169, 819. Check mark.
How about number of shares outstanding?
Well, wait a second.
Oh, sorry about that.
Listen, Seth, when you see these big jumps, I want you to focus here. These are big jumps here and falls. Like, we got to focus on why this is happening. Because look at the previous 5 years. I mean, it was very consistent in the mid-half billion range, and all of a sudden now it's all over the place. Do you see what I'm saying? These are the things you have to look for. This tells you a story. What's the story? I don't know. You got to figure out what that story is by reading more about them. So, is it a check mark? It's a check mark, but because of... But this is weird. Okay, next. Shares outstanding.
Yeah, we want this decreasing so they're not diluting our stocks, Paul.
295 to 230, check mark. What are you laughing about, Uncle Seth?
The comments. I mean, listen, you just told people that they should go stick their head in their car door and smash themselves to death, then kill themselves in their garage. And people are saying that if you kill your followers, we're not going to have too many. And Paul's
true.
okay with that, damn it. Okay, Paul, let's keep
I'm
going.
here for the
For those for you who survive, we're here for you. Current assets greater than current liabilities, pillar number 6, Paul.
Okay, 4.8 billion in current assets. 2.9 billion in current liabilities.
That's pretty good.
Awesome. Yeah,
Yep,
so
that's
they're
great.
good.
What about total
liabilities? 8 billion, so they don't cover it, but still, it's really solid.
Okay.
Now for my favorite thing in the world.
Well, maybe we should stop joking around about you being racist, because now that's kind of a funny bit now. Is racist Paul equals best Paul? How can you be racist and Iraqi at the same time?
Well, that's absolutely...
Asinine to say?
Yes, that's absolutely asinine.
That's why I said it, of course.
Okay, gotcha.
That's my job here.
Yeah.
Free cash flow growth, pillar number 7.
All right, you ready to do some numbers?
I'm always ready. Of course, I'm not ready yet, but go ahead.
800. 800. 1.3. Just call it 1.3. I don't care.
1,300 then?
Yeah, 1,300. 1,170. And 900. So check mark. What's the average? About $1 billion?
Yeah, 990.
So 1 billion times. Now, are they growing? I don't remember how they're growing.
Don't look at me.
Are they growing well? I forget how they're growing.
Oh.
This is very okay. Guys, I will say this isn't bad. This is their average is 1 billion, and they're selling for 13.3. That's 13 times free cash flow. Now, I like this, but you definitely need to do more work to make sure you understand why their revenue and profits all over the place. What are you laughing about? What was the comment? Seth's in tears right now.
John Thiesing, our boy, one of our patrons, says he's not watching the video. He can only see the chat because he must be busy. So it goes from like, Paul, will you analyze Dropbox to Paul's a racist? Like 2 comments later. So it's just funny. We like to joke around, folks. Paul's not a racist. He's the opposite of that. You know why? Because you have black friends, Paul.
I have 2 black friends.
That's right. That's great. That just means you just right. We're going on vacation with all of our friends in a couple. Oh my gosh, Paul, less than a month.
Yeah, I go in 3 weeks.
Live streaming from Mexico, the turn of the year, January
18 days. That's not even 3 weeks.
That's incredible. Live streaming from Paul's Mexico mansion in the beginning of the year, unless the world closes down and we don't go, Paul.
Don just got mad at us because yeah, we're live.
Yeah. Great.
All right, so so for me, if you just want to look at price to free cash flow and PE, the PE doesn't tell the whole story. The free cash flow is obviously better, but it's not terrible. I don't look at this going, oh, this is bad, but you got to understand the story behind it. Please understand the story behind it. In fact, Trader Mo, let's look at some NetApp options. So thank you, John Thiesing, for this little tidbit. Hey, has John bought our Patreon yet?
Oh, he's in. Yeah, this weekend he was in. Yeah.
Oh, good.
Yeah. Paul, I think a lot of people are asking about iRobot. Do you want to?
So I want to do iRobot, and the reason being is
We had some people outside of our patrons. They wanted to hear this too. As
I
well.
sold some iRobot puts yesterday. So let's take a look at iRobot. So for those of you who don't know what iRobot is, they make the Roomba, and they're making like lawn products.
I do love Roomba. Do you have one? You don't have one.
I've had one before. Do you have one?
It broke, and then now we don't have one. But
How did it break?
I don't know. I have to send it in, which I'm not going to do. So
Why not?
I'm too lazy, Paul. You know this.
Send Geo to go. Tell Geo.
I got to ship it up. But yeah. I think it's actually out of warranty as well. That's why I didn't send it in.
Oh, okay.
Yeah.
So iRobot's interesting. I had one like 10 years ago. It wasn't the best, but I think the technology is getting better. They've been around for 30 years. They have a mopping version now too. They're creating one for cutting your grass, etc.
I think in general, you have to buy I would buy the upgraded, the highest version one. If you buy like a cheap one, like a Black Friday special, those are the cheap ones. I think we really need like one of those $900 versions. Those are awesome. We got the 371 and it broke in a few years. So, but we did love it.
Was it good while it was working?
Yeah, every time it goes, it picks up a lot of dirt and all that stuff. So
Interesting.
we love it. I should get one for my wife. Hope she's not watching. But okay, guys.
Okay, so ready to do this?
Go ahead.
$2.1 billion company.
This is iRobot.
2.2 billion. Let's call it 2.2. PE of 14. So check mark there.
Very nice.
Profit margin 22.57.
Love that,
Check mark
right?
there.
Yeah, great. How about revenue growth over the past 5 years? Revenue growth.
I love how you say it and then you repeat it.
John is saying we're all over the place. Is there such a thing as excessive comedy or just fundamental comedy? That's an interesting point. We are all over the place.
You mean with our comedy?
Yes.
I like excessive, cutting edge, like hit it hard kind of comedy.
I think we do this live, guys, because we also love busting chops and having fun.
Exactly.
People have asked us, why don't we just record this show and then just spit it out like
It's
Graham
so much more
Stephan?
fun for people to say Paul's a racist or me to say advise you to take your head and put it in your car
Yes,
and slam
'cause-
the door.
Yeah, but it's just funny, I think.
Revenue,
We have to have fun doing this or we won't do it.
620 million to 1.2 billion, almost doubling. That's awesome. All right, they've tripled in the last 10 years. And by the way, guys, I don't know what kind of acquisitions iRobot's making because they have like 500 patents. They have a lot of things going on, maybe 1,000 patents, something like that. So I don't know how many acquisitions they can really make.
Vinny, I know what you're talking about with that. I know what you're talking about with that quote, and it's hilarious. And Paul's never seen any movie ever, so
What quote?
it's from Godfather.
I've seen
Or
Godfather.
no, Goodfellas, I think.
I've seen Goodfellas. No, I haven't seen Goodfellas.
I'm gonna get the papers. That was Tommy two times or something.
All right,
Vinny?
Tommy
Write
Two
that down.
Twat.
Yeah, go ahead,
44
go ahead.
profit, 85 check marks. They've doubled their profit.
Nice.
And then in the last 10 years, they've tripled their profit. So they've doubled their sales in the wait, what was it? They doubled their sales? No, they tripled their sales in the last 10 years and tripled their profit tripled their profit in the last 10 years. I like it.
How about number of shares outstanding? Pillar number 5. We want this going down.
29.55 down to 28. But it went down to 27.7, 27.6, 27.7,
Then
and
back
jumped
up.
up. So it's technically a check mark, but find out if there was an acquisition made here or something that caused them to issue more shares. I don't know. I don't like that, but we'll see.
Current assets greater
By
than
the way,
current-
I don't care if they're buying shares back. Just keep the shares the same.
Right.
I mean, and again, even with keeping the shares, increasing shares, as long as they're making a good acquisition. The problem is companies tend to overpay for acquisitions because it makes investors feel like they're doing something to make and shake things happening. Balance sheet. I love this one.
Current assets over current liabilities. Pillar number 6.
808
Beachfront Avenue.
A1A,
Sorry.
Detroit Avenue.
No, I'm talking about Vanilla Ice.
A1A, Detroit Avenue. Did I say beach? Wait a second. What's the song with Detroit Avenue?
I don't know, but you're wrong.
I know I'm wrong on that one, but what's the song with Detroit Avenue? Because A1A is on the beach, but there was a Detroit Avenue song. Somebody look that up.
Current assets greater than current liabilities. Pillar number 6.
265. 808 versus 265.
Wow.
Wait.
Wow.
Okay, so guys, total liabilities, 808 minus total liabilities of 335. That is $470 million more. If you remember, the company was 2.2. We got to take out the 0.47. We're left with $1.73 billion for the company. So now all the numbers are shifted down 20%. So it goes from a 15 PE down to a 12 PE. Because when you're buying the company now, you're buying $800 million in cash with only $335 million in debt. You're getting an extra $470 million right then and there. Do you follow what I'm saying here?
They have 470 in the bank. So if you buy the company for 2.2,
They have a net 470 in the bank. So if you buy it for 2.2, you're actually paying 1.7. What is it?
So it's Beachfront Avenue?
Yeah.
It's been mistaken to be Detroit.
Maybe that's where I got it from.
oh, Detroit and Detroit, I see.
Beachfront
818.
But 818 is not a Detroit area code. 810 is Flint. 313. So that's I don't understand why that's the connection.
Corey asks, how does someone that can't pay for Y charts, this is a great question, get this information or find indicators like this? I see. For the 250-day moving average. Corey,
guess what? Guess how you're going to find it, guys.
Your Uncle Paul.
Everything Money website and app is coming out. It'll have all of this stuff. Don't be cheap. Go spend the $8 minimum. Just have the $8 Patreon and wait there because it's going to be 15 or 25 bucks. I pay $400 a month for this. I pay so much money for this, and I'm going to give it to you. I am literally going to get their data from the exact same place they get the data. I'm spending $30,000 a year plus developer costs to be able to provide this for you. That's how you'll get it. You'll be able to log in your website and do it, and the app will just tell you the number of shares. If you aren't willing to pay $8 a month now for the 3 or 4 months it's going to take,
Paul, careful. I know where you're going with this.
I'm going to throw something at you.
No, you set that up. It's like if you aren't willing to do this, then you can go kill yourself.
Well, no, but if you're asking for this, it'll be there.
That's true, Paul.
That's what I'm saying. Don't be cheap about it.
Are the 8 pillars best for investing in long-term dividend stocks, Paul? Ziggy asks.
8 pillars in themselves just give you a highlight of what the company is. There's no reason you should make a decision. I've bought companies that had 2 of the 8 pillars, and I've not bought companies that had all 8 pillars because it's more than just the numbers. It's all the story behind the company.
Inca Warrior says TradingView has a good platform.
Oh, TradingView?
Yeah.
Good.
Inca, tell us why you have that name. We're big fans of the Incas, Mexico. Obviously, how Paul has houses in Mexico. I love like when I see specials about Incas and their history back in the day is incredible. I like that. Anyway,
cash flow. Let's go to cash flow.
Free cash flow, pillar number 7.
All right, you ready, Seth?
See, every time you ask me if I'm ready, I got to fire my phone up. Go ahead.
16, 106,
Wow.
53, 39, 95.
They're all over the place, Paul.
Yep. Average?
62.
Okay. This is big increasing, guys. This is big time increasing. If you just multiply it by 20, you get 1.2 billion. And we needed a value of 1.7 after cash. So it shows less than it should be.
What is that?
That's 1.7, it's showing $1.2 billion is 20 times free cash flow. But guys, I'm not exactly going to say that's right. I actually wonder if it's still, let's see how they did the last 12 months. They probably jumped up a lot in the last 12 months. Ooh, wow. Last 12 months, they did 225 billion in free cash flow. Wow, they jumped up a lot during this downturn.
Inca, are one of our followers, they are from Peru. I forgot about this, Paul. I'm dying to go to Machu Picchu, but keep going.
Sweet story, Seth.
Isn't that nice? This guy.
Guys, I'm not opposed to. Here's the deal. I sold puts on iRobot. I don't remember what price, but I did sell them. I don't know if I'm against this company even right now. I mean, if you believe the iRobot story, so this is the caveat I'm saying. If you believe iRobot will be the leader or be a good company for a long period of time and grow their revenue on these robotic vacuums, and I don't see why this is a bad buy now. You have to understand the qualitative aspects of the company. They got great margin. They got great revenue growth. They're selling at a reasonable multiple. Their company has very little debt.
Nick L., one of our patrons, is asking about, let's take a look at momentum.
Let's look at momentum. Okay, it just crossed over. The 200-day just crossed over roughly here. So it's a little bit down since you would have bought. And look at this. Just to show how it can go up and down all the time. You would have sold right here at roughly 63, and you'd have bought back again at 75. So that just goes to show that the momentum thing has to be done consistently and over long periods of time. But I don't know if I'm actually against. I mean, I look at the saying, if you believe the IRBT, so Trader Mo and I were having a discussion about this yesterday. He was against it. I was kind of buying into the story. He says their product is a crap. Or no, he wasn't saying that. He was saying it's too many competitors, which could very well be the case. But I think that Roomba is the leader, wouldn't you say?
Yeah, I mean, I can't even think of another vacuum company like that. I'm sure they're there, but...
And look at their revenue. They did, in this year so far, they've done 193 plus 280 plus 413. So 6, 7, 8, 9, $900 million in 3 quarters. Right? So they're on pace to do what they did last year, even with a major downturn. Major downturn. I mean, look at their sales. in the first quarter of the year this year versus the first quarter of 19. I don't know. I'm not exactly upset about this. I want to understand how they made so much money this year so far. Because they have a big gain this year so far. Net income of 153. So they're selling for about 12, exactly what I said, 12 times. Is there any sort of sales marketing expense, research and operating, other income and expense? Oh, they had a big other income here. There we go. There we go.
Paul, they want you to debate Stock Mo.
Listen, I know this sounds funny. A debate with somebody like that will never ever work.
Why is
Because
that, Paul?
he's going to sit there and say, you're wrong. Look, it's up 600% this year. And what am I going to say to that?
That means a buy.
What am I going to say to that?
Numbers?
And what's he going to say to that? Numbers don't matter. Look, the numbers work. It's a growing company. It works.
And the projections, Paul, for next
Great.
year.
Yeah, the projections are great. It's awesome.
I wonder what the projections for 2019 for all these companies for 2020. Remember how 2020 was going to be the best year ever?
Projections are always if you go look, the average projection every year for stock growth is about 10%. Why? Because the market does about 10%. So everybody goes, it's about 10%. Guys, it's not going to, debating stock mo will never ever work. Unfortunately, it's going to end up being, for me to end up winning a debate, it's going to be him just losing a lot of money, unfortunately. But right now, he's making a lot of money.
So I cut you off. Final thoughts on iRobot.
So there is a $50 million other income here that, they have consistently a few million dollars in other income. So this is a big number. I want to subtract a lot out of that. But still, it's not selling for, you have to believe the story here. And the story, because it's such a small company, story matters more and more. If you believe they're going to grow consistently and big and fast, and they're going to be a leader, I think this is a buy right now. If you believe that story. I will never ever say you 100% buy a stock just on the numbers. Now, I sold puts at a lot lower price. What did I sell the puts at? Does Trader Mo remember? Can somebody ask him?
It is a caveat with this channel is our dear friend Trader Mo is in the chat as always. He is in on our live streams, our Patreon only live streams, and he will be joining us again this Thursday at 7:30. Patrons, we'll see you there. Love you, Paul. It is once you get this final numbers, it's 2:15. We've been going for an hour and 15 minutes. Should we end with one more? Maybe IBM. Bogdan's asking.
IBM, let's do IBM because it's going to be a slow grower. Now keep in mind, guys, with IBM, one of the things about IBM is they're going to make a lot of acquisitions because they're such a big company. How do you grow revenue when you're already so big? You grow it through acquisitions. So let's look at IBM.
Market cap.
By the way, I want to make note, IBM is currently, its peak in August of 2000 was 132. What's it currently selling at? 125. It is down from where it was 20 years ago, August of 2000's peak. Just keep that in mind, folks, when you say stocks can't go down, stocks can't have 20. If you told somebody in August of 2000 you're going to buy IBM for 132 and it's going to sit there for 20 years, what would they have said?
Never buy that.
No, they said it was never possible.
Well, never
possible. That's not
possible.
going to happen.
Right, stocks always
look
go
at
up.
stocks. Stocks always go up. Look at IBM. It was, Paul, just 7 years ago, it was $12. Now it's $130. It's up 10 times in 12 years. It's going to be up 10 more times. Okay, sounds good. Sounds good. That's what I sold the puts at? Excellent.
What did you say, Paul?
iRobot. I sold the puts at 50. It's currently at 77. So I've got so I feel like that's a good margin of error for me, margin of safety for me. Okay, so let's go look at IBM. Ready? Let's have some fun. 110 billion.
Wow, this is funny, Paul. Benjamin said, remember when IBM's Watson was going to be the best thing ever? They had commercials for Watson.
They still do.
Yeah, I don't even know what they're commercializing. I don't even know what they're telling me. It was on Jeopardy that one time.
Well, it's kind of like the UPS commercials, and they have some guy sitting there going, I see logistics. It's like, shut up, you don't see anything.
Keep going.
Okay.
What's the market cap?
112. Why was that funny?
Just when you do stuff, it's funny.
No, seriously, people are like sitting there and they say that. I'm like, what are you talking about? Okay, PE 14.
That's
check
nice.
mark.
I like that.
Yep. Profit margin a little bit below where we want it. Although I will say this. In the last 12 months, it's up over 10%, so I'm going to give it a check mark.
Okay.
Gross profit's 48% of the nose. That's pretty solid.
How about revenue growth?
Well, hang on. Peanut.
Sorry.
Peanut. You always jump ahead.
I try to drive the show, Paul. It's
Great. You're doing a great job driving this to shit.
Go ahead, Paul.
5.2% dividend. Don't you like dividends?
I do. I like that.
5.2%. Not as high as AT&T, but still 5.2% dividend. What's next, Seth?
Next is.
You don't even know yet?
Let me slowly check.
Revenue growth.
Revenue growth
this is trailing 12 months. Let's get rid of that.
Pillar number 3, revenue growth, baby.
All right, ready?
Paul has no time for BS. That's right, Dom.
81.7 down to 77. X. Guys, look at their revenue. It's down a lot in the last 20 years, in the last 10 years. $100 billion down to 77. They probably sold a lot of divisions off or something, because we'll have to find that out, but that's a big drop.
Profit growth, as I'm assuming, is not doing well either.
Let's find out. Yes, profit growth is also an X. So profit has gone from 13.2 down to 9.4. X as well. Now remember, guys, if I told you there was a company that was going to make you $5 billion, then 4, then 3, then 2, then 1, and then go under and show the door, is this worth 0?
No, it's worth
No,
something.
it's worth something because you're getting 5, 4, 3, 2, 1 along the way. Would you pay $1 billion to get this stream for the next 5 years? Of course you would. Would you pay 2? Of course you would. But there's a number that makes sense. So just because it's dropping doesn't mean it's bad. It's the multiple you have to pay to drop. Would you pay $50 billion for a company that's going to make you $10 billion in the next, or $15 billion in the next 5 years, then goes to 0? Of course you wouldn't. That's the point. That's the way I want you to think about investments. It's not about where it's going. It's about what you have to pay for where it's going. You're going to make the determination of where it's going. They need to decide, what am I willing to pay to get that future? That's all investing is. What are you smiling about there, Giggles?
Alkali, I think Alkali is one of our patrons, was saying Watson is AI. I guess the point is, as when they're marketing it to me, I don't know what I'm supposed to like or not like about it. So
I think it's just brand awareness. IBM's so big, they're just trying to build brand awareness.
There you go. Great point, Paul. Should we do pillar number 5, which is number of shares outstanding? We want that going down?
Check mark, 978. So a little under $1 billion to 887. So they've done a good job with that.
Okay.
And even the last 10 years, they've had a lot of. And by the way, that's how you can get your growth in stock at some point, is with the company buying its shares back with free cash flow.
Current assets.
Oh, by the way, they need about $5.5 billion a year in dividends. That's what they pay. 5.7, call it 6 to be conservative.
People are really wanting you to do AT&T today, Paul.
I already did AT&T like 18 times. $40 billion in current assets, $38 billion in current liabilities. So barely a check mark, but it's still there. They got a lot of debt.
Okay.
So it's still a check mark, but that's kind of worrisome. That's not a big buffer.
Free cash flow growth.
Are you ready?
I'm ready.
Okay. 13.1. 12.9. 13. 11.3. And 11.8. So X again. The average.
12.4. 12.4.
I'm going to pay 10 times that. This is a losing company. Actually, probably even less than that. I probably want to pay 8. I don't know. Probably want to pay 8 times that. So call it $100 billion. It's currently at $113 billion. It's pretty close, guys. The reason I'm doing such a small amount, you got to really make your money because everything shows this company is losing revenue and profit. So if you have to assume that keeps going, if there's not a story that you can sit there and see how it gets better, then you got to do that. Let's see their acquisitions. They spent $31 billion in acquisitions. Yeah, they spent a lot of money in acquisitions, guys. What did they buy in freaking 2020? Let's see how they're doing in revenue the last 12 months. Trailing 12 months revenue. It's still down from last year. Jesus Christ. How about their profit? Their profit is down also. Yeah, this is tough, guys. So this is where it is. When you see a company losing this much revenue, this much profit, you got to pay as little as possible. I mean, maybe 113 billion is too much. Maybe 100 billion is too much. Maybe you need to be at 80 billion. I don't know. But the good news is, if you like their free cash flow, they need to spend a lot of more money on the free cash flow to buy dividends back. You know, I actually want to avoid IBM. I think. Look how much debt they have. They have $130 billion in debt, and their revenue is going down, their profit's going down. That's not a good scenario. How do you retire your debt with your revenue and profit going down like that? I'm actually going to say avoid IBM. This is an example of, a low multiple that I'm ignoring. I mean, 20 times free cash flow. What was the average free cash flow? 12.4 times 20 would be 250. I'm saying no. It's at 113, 112. It's over double. I would say no to that. I don't want that. This thing is dropping and dropping and dropping. This is a concern of mine.
Are you tired?
My throat's hurting.
People are asking about AT&T.
What was that?
People are asking about AT&T.
Jesus Christ. I will do it.
AT&T.
Somebody sign up for the Patreon. I'll do AT&T.
He's going to stand here in dead silence until...
I'm just kidding. I'll do it. Wouldn't that be epic if I did that?
Somebody probably would. Yeah. Ziggy's asking about a lot of people. Oh, the Bogdan just signed up. There you go. Bogdan, I'm not surprised you're here with us most of our live streams. So it's good to see you again, my friend.
Okay.
Yeah, here we go, Paul.
AT&T is still at $30. All right, $220 billion market cap. 220. PE is actually high. It's actually over 20 now because it's gone up in price. Profit margin's low, 6.7%, 2X's so far.
Uh-oh.
But a 7% dividend yield.
Wow, love that, right?
That's big.
Do they have the money for that dividend?
That's $14 billion they need just to pay the dividend. Financials. Revenue. The revenue is going up, 147 to 181.
Very nice. Profit growth, pillar number 4.
Profit growth, check mark as well. Barely, but check mark as well. It made some big money in the last few years.
Shares outstanding. We want this down, baby.
This is definitely going to be down. Oh, wow. It's
Looks
not.
up. It's up, Paul.
It's up a lot.
Uh-oh. Current assets over current liabilities, pillar number 6.
50 versus 59 negative. Not
Uh-oh.
good. Cash flow.
Free cash flow growth. This is
They have
7.
a lot of free cash flow. Jesus Christ. 16, 17, 18, 23, 27. Wow, they have really increasing free cash flow. That's an average of like 22 or 23. So you're buying it for single-digit free cash flow. So the positives of this is the free cash flow multiple is insane. The negative is increasing shares outstanding and decreasing profit. Was it decreasing profit?
Yeah.
No, it was increasing
profit, yeah.
Let's see the trailing 12 months free cash flow. Wow, $28 billion in the last 12 months in free cash flow. Good God. I mean, their dividend yield, their dividend is safe because they have $28 billion and they need $15 billion to pay their dividend. That's a lot. That's really good.
Did we miss a boat on buying this when we told you guys to do so 3 months
I think
ago?
we said it at 27 before. Wasn't it 27 or something like that? No, maybe it wasn't 27 then. Maybe it was still in the 20s, but maybe it was in 27. Listen, you're not buying this for growth though, guys. You're buying this for very little capital appreciation and mostly dividend. Because they probably spent a lot of money on acquisitions. Let's see their acquisitions. On the cash flow statement, there'll be actually they don't spend, oh, there was a big acquisition here. That's not bad, 41 billion right there. Wow. So along the way, they've actually sold stuff. They've been net sellers 3 of the last 4 years. That's interesting.
Can you look at their momentum?
Yes, let's look at their momentum.
I don't think we did before.
Let's look at that momentum. Let's
Uh-oh,
get the
look at
momentum,
this.
son. All right, so guys, it crossed over at 35, and you bought it and then sold, you would have lost money right here. So that's one of the problems with the momentum is you can lose money as long as you follow it. That's the way it works. Big sell off in March, and then bounce back up. So AT&T is one of those. If you love the dividend, you think it's safe. They're buying this. Find out why they're spending so much money on.
Some people are saying they're going to somehow get in partnership with HBO Max, who's going to be releasing movies directly at HBO Max.
That's possible.
And that sounds like great, maybe a great climb next year. That is true. They're going to start releasing brand new movies to HBO, Paul. I think like the Wonder Woman movie or something. It's all
AT&T is?
No, HBO Max.
HBO Max.
Okay. Well, listen, AT&T is a big company. They got a lot of, everybody knows AT&T. Your mom worked for AT&T for how long?
50 years, yeah.
Yeah, 7% dividend yield. I mean, I'm kind of stuck on this one. I think I said that before. I'm kind of stuck on this
HBO
one.
Max is their subsidiary company.
HBO Max is a subsidiary of AT&T?
That's what Bogdan's saying. That's who, yeah, interesting.
Wow, I didn't know that.
All right, guys, make sure you smash that like before you jump off. Smash that thumbs up. We appreciate it. If you haven't subscribed yet, please do. We will see you Thursday. Patrons will see you Thursday night. I think we've beat this horse to death. Patreon.com/everythingmoney. Paul, thank you for your insight today. Man, you just jammed for 90 minutes, bro.
Welcome. That's what I'm paid to do.
Yeah, just tickle that like. We love you guys, and thanks for following. See you next time. And we post shows every day. Love you. Bye, guys.